we're likely to see the banks starting to fall. I'm looking at, for example, I put on Twitter the long-term chart of Citibank. Looks like the cliff of death. Looked like all of the European banks did. I've been looking at Bank of America. Doesn't look great. And then the regional banking index, the KRE. So that would be a tipping point that would start changing the equation. What else can uncouple markets? Well, the bond yield issue in itself can uncouple markets. But what it's telling me is we're getting closer to more cowbell.
Renowned macro strategist Raoul Pal foresees significant developments in the United States economy and markets in 2023, driven by the Federal Reserve's aggressive rate hikes since March 2022. While the Treasury Department maintains confidence in the economy's strength, several sectors are displaying signs of vulnerability, particularly the banking sector. Pal notes that the regional banking sector crisis, which impacted smaller lenders earlier in the year, appears far from resolved. Recent downgrades by S&P Global Ratings and Moody's underscore concerns about funding risks, deposit outflows, higher interest rates, and regulatory weaknesses within the banking industry. This fragility could prompt the Federal Reserve to reconsider its monetary policies. Pal suggests the possibility of a significant policy shift by the Federal Reserve in the final quarter of the year, which could trigger substantial rallies in cryptocurrency markets. These rallies may be fueled by the conclusion of summer holidays and any indication that the Federal Reserve is transitioning from rate hikes to rate cuts. In the broadcast, Pal also shares his broader outlook for the economy and markets, along with his top 3 trades for the forthcoming cycle.
Markets are just sloppy. There's nothing really going on. There's no new money around. Everybody's in the Hamptons. All of that kind of stuff is going on. So you have to be patient in summer markets. And usually, once you start getting through August, September, things start kicking off. The things that I'm looking to kick off are, as rates have been decoupling from the market. So I actually got stopped out of my bond trade. Finally, I got out of that bloody pain. It was a terrible position because bonds basically decouple from the business cycle this time around. It's nothing to do with inflation. It's actually to do with liquidity because of how the Fed are, the Treasury are issuing so many new bonds to pay the interest on the bonds because rates are so high. They're doing it in the bills market. That's draining the reverse repo, but it's still flowing through into the rest of the bond market, and yields have been rising. That whole process has started pushing the banks lower again. So I'm keeping my eye on that. But what it's telling me is we're getting closer to more cowbell. That point where the Fed have to go, oh, and that happened last time, if you remember, in December 2018, when suddenly the repo market broke and the Fed was like, we're stopping QT, and we're not going to hike anymore. And then they started cutting 6 to 9 months later. We're in that phase, I think. Let's see what Jackson Hole has. Powell still thinks he's Volcker, and it's a ridiculously different environment, but that's what they want to believe right now. So my guess is that the payback for this is I think they're going to undershoot inflation. So I'm strongly of the opinion inflation is well below 2%, maybe even as low as 0 by the end of the year. And that's been my call for a while now. And I think core inflation goes to 0 by summer to this time next year. So I think we've got all of the inflation domino to play out from the GMI business cycle dominoes. We have, I think, a rise of unemployment will come over this period. I don't think it's going to be huge because there's some complications in the labor market as people are leaving the labor market, etc. And I think rents are coming down, all of that stuff. So what we're likely to see is the Fed going, oh my God, sorry, we've undershot, which gives them the cover to cut rates, which they need to do because they cannot pay the interest on the debt at these levels ongoing. They've got about 13 trillion of debt to roll over plus new issuance. They need to get rates lower and they need to then monetize the interest payments. That's part of the everything code thesis, those of you who have been following along at home. So the everything code thesis suggests that Q4 is going to be when this start of action starts happening and we don't, maybe QT stops, maybe we get a rate cut, maybe we don't, but we start flagging it. And then we start to see, I think, another leg of the economic slowdown. I think we're actually bouncing out the forward-looking indicators of ISM, all of this stuff I've been talking about in pro macro on Real Vision. That's where you get all the juicy stuff. So you guys watching this, most of you aren't pro macro subscribers, so you don't get all of the research that I put together, but we do a lot of stuff. And that's suggesting that we are going to seeing a sharp economic rebound. That was forecasted by liquidity and the GMI Financial Conditions Index. It is starting to slow down a bit because of these yields and the dollar stabilizing. And so that suggests that Q1 next year, so we might get a pickup in growth at the end of this year. Now, that won't come into GDP. GDP's lagged. Everything kind of lags in this. So GDP should be weaker in Q4. I know that the Cleveland Fed have this ridiculous 5.9% number. That'll go away. But we should see GDP low, but the forward-looking indicators, stuff like ISM, start to pick up. And then we might get another slowdown within Q1, but I think at that point the market is more focused on the cowbell.
Many prominent analysts and economists, similar to Pal, are also forecasting a rate cut, possibly occurring during the first or second quarter of 2024. The National Association for Business Economics conducted a survey, revealing that economists estimate a rate cut by the Federal Reserve in the first quarter of the upcoming year. However, Goldman Sachs economists hold a less optimistic view, as they anticipate the Fed to commence rate reductions by the end of Q2 2024, with subsequent cuts every quarter. Their rationale is tied to the desire to normalize the funds rate from a restrictive level once inflation aligns with the Fed's target. A Bank of America Global Fund Manager survey echoes these expectations, with participants foreseeing the first FOMC rate cut potentially occurring in the second quarter of 2024. Regardless of whether the cuts happen in the first or second quarter, even a subtle indication of the Fed's willingness to be less aggressive could trigger immediate rallies in the cryptocurrency market. In the interview, Pal delves further into his economic outlook and shares his top 3 trade recommendations for the upcoming bullish cycle.
Then we're into the full election year, and the full election year is cowbell central, because then you've got stimulus to try and bribe the voters, rate cuts to bribe the voters, the use of the balance sheet to try and not get the Treasury to end up with ridiculous debts on their trying to issue ridiculous amounts of bonds and the market not being able to do it and crowding out the private sector. Sorry, I'm speaking very fast because there's a lot in the everything code and I can't really get it across in a very short thing. Anyway, all to play for. Q4, when it gets interesting, everyone needs to get back from holiday, and then we can see from there. David Kelly, afternoon, Raoul. How do you see real yields playing out? Well, real yields are a real issue. They're too damn high. I mean, they're super high right now, and that is going to continue to erode inflation and economic growth going forward. So my view is that countries high in debt cannot run long-term positive real yields, and that the trend rate of real yield is probably negative 1%. So I think in the next cycle we go back to trend rate of real yields, and I think that is the only way you can get around an aging population with massive debts, and we see that all over the world. Raoul, John Kitchener, I'd love to hear your thoughts on Citi. I don't know, but I've used these very long-term charts of banks since the European crisis in 2012. And I've called it the cliff of death. And one by one, many of these banks have gone over the cliff of death and they've needed to be bailed out. Whether it was the Italian banks, the Spanish banks, the German banks, the Swiss banks. And there still seems to be an ongoing rolling thing. It's like the broken banking system globally. And Citibank is one of those. It just looks like that. It never recovered. I mean, it just fell like a stone and then has been trading sideways ever since. And that cliff or that plateau feels like it just wants to jump off that. So I don't really know what. Well, we know why. Rates are too high, the yield curve's inverted, the banking system's not fully functioning, et cetera, et cetera. So there's a lot of reasons why not to like banks, but cyclically at this point, they should start to improve once the yield curve improves. Banks aren't always negative, and as soon as we start to get the yield curve steepening and rates coming, then banks tend to do okay. So that's usually fine. What are your top 3 trades? John Floyd. John, my trades, I'm not a trader really. I think you've probably figured that out by now. My time horizons are very long. So for me, it is number 1 crypto over my time horizon. Let's just use this business cycle, not even going further out. Let's say over the next into end of 2025, I think crypto is the best performing asset in the world. I think technology stocks are number 2, and number 3, tricky, could be something commodity related, copper. Let's go with copper.
The Bank of America Global Fund Manager survey also sheds light on various economic concerns among participants. A significant 60% of those surveyed anticipate weaker global growth. Additionally, 68% believe the U.S. economy will experience a soft landing, while 21% foresee a harder landing scenario. Regarding the timing of a global recession, 48% of fund managers expect it to commence in the first quarter of 2024, while 25% believe it may start even earlier, potentially in the final quarter of the current year. The recent downgrades in ratings for major banks have raised concerns about potential weaknesses in the banking sector. Unmentioned banks like JP Morgan and Bank of America experienced almost a 2% decrease in their stock prices, while Citigroup, Wells Fargo, Goldman Sachs, and Morgan Stanley saw nearly a 1% decline in their share values. Furthermore, there are hints of more downgrades on the horizon for the U.S. banking industry. Earlier this month, a Fitch Ratings analyst mentioned that the credit agency is not only considering downgrading major and regional lenders it covers but also lowering the industry's overall ratings. The impact of these downgrades on the banking sector and consequently, the broader economy remains a topic of concern. Share your thoughts on how these developments might affect the banking industry and the overall economic landscape. Additionally, feel free to comment on Raoul Pal's interview in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.